Hi everybody, welcome to another update on the stock screener. We are continuing with our VS, Pieridae Energy vs Petrus Resources this time. I got a ping about Petrus Resources that it was a very good play, so let's compare it. As you know, we need to invest in natural gas. EV boom will put more electric cars on the road, which will increase the electricity consumption. And we still have the arbitrage between US and EU gas. So oil demand going down and more EVs lead to higher natural gas consumption. This is the arbitrage play. We are already at almost $8 here per MCF. And then here EU is at 35. So there's plenty of upsides. These will converge with each other. So we are going to play this orange natural gas price. So Pieridae Energy, very good chart. It's in an uptrend. Petrus Resources is similar, but let's see who has more upside here. Okay, so these two companies are similar in market cap. Petrus Resources is 30% higher, actually 50% higher, but very comparable. The PE ratio is at 5, but they are going to increase production very fast, so this could come down very fast. Gas production is at 80%, 70%. It's almost the same. As you can see here, production is at 6,000, but going to 13,000 by next year. So very fast growth. Still a lot of capacity that they can increase. It's only 30% utilized. Here it is 50% utilized. So both looking good. Debt, we have more debt at Pieridae. So if you like financial leverage, Pieridae is still better. Here we have less debt, so less leverage when you pay off the debt. Now, decline rates, that's important. We have lower decline rates at Pieridae Energy, only 8%. Here it is 30%, which is at the high end of the gas companies. And you can see that here as well, CapEx is much higher. 50 compared to 100 to 130, and in 2022 it was even higher than 130. So they use a lot of CapEx, and that could be bad in my eyes because all of the money is put back into the ground. So, okay, there's growth, but yeah, I don't like to see CapEx being so high because that means free cash flow is much lower. So here we have 200 free cash flow, here only 50 because of the high CapEx. Now, operating costs are better at Petrus Resources, a very low operating cost. Tax pools, we have 700 million here, but I couldn't find any tax pools at Petrus Resources. Not sure if they even have tax pools. Reserves were not that great. Based on the reserves that I saw of last year, they only have like less than 10 years of life. But they are going to drill a lot of wells, so these can be increased. Royalties based on the last Q3 numbers was around 25%. It was lower in the other quarters. I'm not sure why it is so high, but yeah, pretty high royalty numbers. So let's look at the free cash flow numbers and leverage. Here you can see we have plenty of upside, 10x at a 10 AECO gas price, and even at 5, we still have double to a triple upside. At Petrus Resources, this is a completely different chart. You can see here that these lines are much wider. And why is this? Because their production is going to increase a lot. Here you don't have a lot of production increase. Here you have a lot of growth. So yeah, very high growth company, but because of the high capex, you can see that most of these lines are very low, almost at the zero line, because they use all the capex to grow. So yellow line is market cap. At 5 AECO, there is a bit of upside, but not a lot due to the high capex. But in the coming years, when they grow more, then there is a double, triple in upside, even at 5 AECO. And at 10 AECO, you have 300 going to possibly 1.5 billion. So that's 5-6x. So a lot of upside if and only if they can drill good holes. Okay. This is not guaranteed, this growth, but it's looking good. They are doing very well. Production is going to 13,000 by next year, going to 15 to 16,000. So yeah, very good. For 2022, you can see that it's overvalued, but when they grow, then it becomes undervalued. But let's take a look at the 10 AECO, the dream scenario. Here you have a 15-fold, but here you have only 5-6-fold. So leverage is still higher at Pieridae Energy. Here the leverage is lower. So I still prefer Pieridae Energy actually. Here you have the risk that you have capex overhangs because of inflation, because of bad wells that could be drilled. And that could have an effect on the free cash flow because of the high decline rates. So I think both are good on itself. This is a growth story. This is an undervalued play, financial leverage, low decline play. So yeah, it's difficult for me to choose which one is better here, but I would prefer Pieridae more because at low gas prices, at 5, for example, this has still upside. But at 5 here, you can see that we are in this scenario. So not a lot of upside when you stay at 5-6 AECO because of the high capex. Here at 5-6 AECO, you still have upside. So actually it's very easy. We stay in Pieridae Energy and we remain unbeaten. Let's see who can still beat us. And I'll see you in the next video. Bye.